All right, Joel Alconin, along with CC Lagator here. I could say Turbulent Tuesday, but it's not Tuesday, so we'll call it Wild Wednesday. And CC, I'll just tell you, you know how we come up for a title for the PMP show?
Yeah.
Well, today we went away from buy the dip.
Okay.
We penalized, but we said sell the rip.
Well, that was right.
Yep.
Yeah.
Yep. So here we are, right back where we started from, CC.
Yeah.
I was out the last couple of days last week, so you're gonna have to catch me up. But we got some turbulence here in the market.
Well, I'll catch you up. We have not invaded Greenland.
What about Canada?
So, I mean, that's sort of the interesting thing I would say about all of this volatility is we've been talking on the show the last couple of weeks. We started off the year on the show basically like hammering home the point that volatility was too low, right? And it was too low for multiple in both directions, I would say. We were just getting to that point where we were trying to break out to a new high, trying to get above 7,000.
The wall we talked about.
And it failed again. I mean, failed is I guess you could call it a failure now at this point. We'll see what happens next. But the point was you were watching IWM breakout. You were watching some pockets of euphoria, like the storage stocks, which we've hammered on. But then it was starting to get into like sort of other areas. Yet the entirety of the market was being held down by these mega cap tech corrections, which are still going on. If you look at, the Microsofts and all of the world. I kind of I'll get to those in a second because they're kind of getting interesting into earnings, some of those names, right? So my take on like the overall backdrop of the market is I don't think the market can make new highs unless those stocks participate. And you've seen it this past 2 weeks, which is you can have SanDisk going up 500%. You can have rotations into the financials before their earnings, right? They were really strong. You've had consumer staples that have taken the baton. So all of these baton passes haven't been enough to make up for the fact that some of these, that Nvidia hasn't gone anywhere in 6 months and Microsoft's gone lower, and some of these big names, and just the sheer weight of those market caps, it's necessary for this market to go higher. So that was sort of the backdrop of the low vol take that we've had going into this year. And the other kind of interesting thing on that front is if you look, Joel, I know I'm hitting you with a random one, but go to my chart real quick. I just wanted to show, and this is something we actually started pointing out towards the end of the year. So I'm going to go on like a 5-year chart of SPX.
Oh, 5-year. Oh,
yeah, boy. So only because I want to show you, and I think you and I have spoken about this on air. The similarities of the setup last December into January are almost exact, right? So if you look at this, the SPX, this is the end of 2024, a year and a month ago. The SPX made a new high just above 6,000, right around a big whole number like 7,000 that we're near, right? It made that high in December. It hit some volatility into the beginning of January. And then exactly about where we are right now, it bounced again, made a new high into like sort of late February. And then the tariff tantrum happened, right? So we are repeating this part right here. I don't know if I'm going to pick it up, but we're repeating this part, like this is a 1-year chart where we're seeing a little bit of volatility. And then we, it's possible we bounce and try to make a new high, especially dependent on these earnings. And then this is, I think, what's in everybody's memory right now is that April swoon. And I think the Greenland headlines and the fight with Europe, and it's sort of like it's triggering some scar tissue in the market right now. My personal feeling on the Greenland stuff is I think eventually we almost already got a taco part today, right? And I think it was why the market opened so
Yeah.
strongly. Is it seemed like, you know, everybody was kind of backing off. I mean, we were talking about like military and all a couple of days ago. We've backed off of that, but we're still seeing the tit for tat of, you know, Europe is pissed, rightfully so. And so they've sort of kind of, you know, dug in their heels, I would say, this afternoon, you know, during the trading day today. And I think that's why we saw that weakness again. But I don't think this is the thing that triggers the next leg down in the market. I think it's still tied to these upcoming earnings. So I think we're going to kind of clear through this Greenland nonsense. And then we're going to get to the important stuff is when that last week of January and that first February is basically almost all of the Mag 7 except for NVIDIA. And if you want to add Broadcom to the 8, those are farther out, but we're going to hear from Microsoft. We're going to hear from Alphabet. We're going to hear from Amazon. We're going to hear from Apple. That is, I think, what determines where this market goes next.
Well, I mean, and just to, you know, I like to look at these stocks. You know, Dennis hasn't been doing as much, but he does these pre-earnings runs with stocks, right? And he, you know, get that alpha. You know, even if it's a crappy stock, you know, anticipation of the earnings coming up creates an alpha in the stock, either for people like, oh, you know, it's going to do okay. And, you know, I'll play it in earnings. So he'll do that pre-earnings run. Now, when things get a little bit rocky on, you know, the geopolitical and the macro front, it's something that he'll back off. But to me, the street isn't, you know, I look at Apple, I look at Microsoft, and I look a little bit longer term. The street ain't leaning bullish into these earnings.
No, like
there's just no freaking way that you can slice it any different than that. The
Joel,
street
look at this.
not leaning bullish.
Look at this Microsoft chart.
I know,
so this is the 1-year chart. This is the 3-year chart. I mean, it's down 3% today, and the market's up, right? So, yeah, this is really. I don't know what the talk on the Microsoft weakness has been, but my theory is that it's getting caught up in the software.
Oh, you just took the words right out of my mouth.
Exactly. So it was an AI play, right?
They started it. They started the AI play.
And it benefited all of last year, you know, on that, you know, like it was one of the main AI plays. You know, they have Azure and, you know, like all that kind of stuff. That's them, right? And yeah. And so then somebody realized, like, when you look at all these SaaS stocks, you look at all these software stocks, I think Oracle's probably getting caught up in the same thing.
How do you know I just put up Oracle? I put a little piece of that at the beginning of the year because Dennis wants me to do these stupid acronyms. Go ahead.
So I think that these things are getting swept up in that. So there's been a bunch of headlines the last week. I don't know if you've been paying attention, but it's got me to a point where I want to start, you know, kind of like doing some of this Claude coding, right? And everyone is doing basically no code apps and all right now for fun. And I think this is like anybody in sort of the software side of this AI trade is getting punished right now. And, you know, like the Googles of the world, which are, you know, sort of taken over the baton, I would say, on the pure AI side of the things, you know, that's the strongest. I think Google's only down like 4% during all of this. Some of these other stocks are down, you know, 30%.
Look at the holdings in the IGV.
Yeah.
I got it up there.
Yeah.
Look at these things.
So that's right there. And, you know, Palantir, I wrote these down. So Palantir's down 22%. Facebook's down 25%. Even AVGO's down 21%. I want to say NVIDIA's like in the teens now at this point, down. Apple's down 15%. Google's the only one that's not struggling. Oracle's down 50%. 50%. So there, right there is why we haven't broken out. to new highs. And even while we're seeing these other pockets of strength, really, like IWM, I can't even explain it anymore. It's still strong with rates going higher. So there's a desire, it seems, to take this market to new highs, but they can't do it without Microsoft.
Okay. All right, Todd. Are we done with your charts here?
Yeah, let's go to this real quick and I just want to sort of point out, not to pat ourselves on the back, but the 1 week expected move in SPX last week, the downside was 6,800 in the cash, which is basically right where we went to yesterday. And then we kind of almost retested it today. So, and that was at like when volatility was just slightly starting to tick higher. And now I think it's interesting to see this update. So, the VIX last week was 15, and that's when we were talking about the VIX being too low. And then we got a spike to about 21 yesterday. We're back to like 19 today. And these are kind of the updated ranges, which you can see is the downside pressure here. If we were to fail to hold here, it would quickly test that 6,700 level, right? And there's really nothing to stop it down there if we were unable to hold the lows of the last 2 days. There's nothing really stopping it, I would say. And you can kind of you can take a screenshot of these, but these should be, if we do break that 6,800 level, this is a good, sort of back of the napkin thing to keep in mind here, is that the options market is pricing a move down to 6,700 in the next week. You should kind of wait until you see what happens there. And that goes to that orange card, Joel. This is something we talked about.
Well, before we move on from this one, CC, two things that stick out in my mind. I was on with you a couple weeks ago, and you gave the yearly range.
Yes.
And there wasn't a lot of upside there.
Yeah.
I mean, I wasn't all warm and fuzzy about that. I think with the cash, let me see. Let me pull up where the cash was. This would be like 2 weeks ago. Let's see the cash. Yeah, let's just say 2 weeks ago today, 21, 14, 7th. The cash was at like 69.20 then, 69.30. I mean, what did you have? Like 7,200 or something? Or 70? Yeah.
So,
it was 7,300, but then on the downside, it was 6,500.
Yeah.
Am I remembering that correctly?
Well, so no, it was higher to the upside, but this is an interesting point you're bringing up, which is a rally from here is sort of dependent on picking up some level of euphoria, I would say, to the upside for us to break out. It needs those mega cap tech stocks that we just talked about to participate, and we would probably see some sort of euphoria. Obviously, after having made a move like we have since last spring, the downside is riskier, right? So right now, the expected move, I'm just looking out to the end of the year, it's about 13-14%, right? So you figure a 12, 13, 14% move to the upside is interesting, right? But I would say that 13% move to the downside is clearly underpriced, right? So if you were looking for, and it still is, and I'm looking out to March expiry. I think when we were looking at this last week, it was about 13 to 14, maybe 14 vol. It's up to about 16. That's still relatively, there's no volatility, hasn't moved significantly over the next couple of months. So if you were looking to kind of hedge your portfolio or hedge any individual holdings for the next couple of months, it's still pretty reasonable. And if you catch an up day where the VIX comes back to like 17, it's even better those days.
Yeah, well, we got to get back to that. Before we move on for this, I just want to do I'm going to bring a correlation from something we talked about, and then I want to relate it to see how it is in the S&P right now. And the correlation that I want to bring up, I remember when you talked about, remember Open Door?
Mm-hmm.
Okay. And remember when it had that just crazy run?
Yes.
Absolute crazy run. And I can't remember, maybe it was back in this area. And you were talking, and we were talking about the options. And you were
Yeah.
talking, well, if you really want to go along this thing, well, you could do that, but just like, and I remember you were looking at like the 13 calls or something,
Hmm.
and they were trading at the most ridiculous premium. Now,
Right.
I don't know how far it was going out, and it gave me the sense like, okay, this stock may go up, it may go parabolic, but the option makers are not betting on their. They're not worried about that risk right now. They're giving
Well,
you the risk to buy that, and to me, there was like, oh my, like people think that, and this stock was maybe in at 10, and they were paying 40 cents for the 13 call.
yeah. Yeah. So this is what happens in these kinds of manias. And I'm actually going back on the kind of 1 year chart to see how high vol got in this thing. So volatility got as high as about 200, 210, I want to say. And that's just the like at the money IV of like, if you look on an options chain, you'll see the little IV number. So now if we go to this chart on open, you can or I'm looking at mine, you can see that volatility even out like pretty much the whole year is down to 100. So it's been cut in half. And what happens here on stocks like this, and it happens
When did it hit 200? Do you have that?
so that was back in,
I
so
mean, yeah,
it hit
September.
200 in August in that first spike, right?
Okay.
And then it hit and then it kind of stayed there. It was over to God, it was even higher. I was wrong, dude. It almost hit 300 in August. And then it it hovered around 200 as the stock kind of like settled in. And basically what happens in a stock like this is the worry and the opportunity of this stock going to 100 when it was at 10 is no longer seems so realistic, right? So people that bought it up, above 10 in September, or even more so back in, you'd have to go pretty far back. But anytime a stock like this has a spike like that, volatility explodes because the possibility, you can imagine, I'm going to get nerdy here for a second. So when a stock is $6 like it is now, I'm going to go out to February 20th. The at the money straddle is about let me just look. It's it's the expected move is about $1.50 in either direction out towards like the end of February. So that means the options market is pricing about a move to 7.5, and that's based upon that at the money straddle. When these stocks rip higher, like this one did from 1 to 10, basically, all of those at the money straddles have to expand so much to account for the fact that if a stock can go from 1 to 10, it can go from 10 to 100. And then once a stock like this corrects and comes back to 6, now all of a sudden it gets priced more like a normal stock. And it's basically saying, all right, well, it failed to get above 10. And it used to be very recently 1. So what is our sort of more realistic way that this stock is going to trade from now on? And that tends to be, now you're at like 100 vol. And the only thing that could change that at this point is another mania, right? Even if this thing drifted lower and kept going lower below 5, you would actually see volatility, it would contract. It wouldn't expand like a normal stock. And it's basically saying the mania is over.
What was the vol back? And can you see where it was in September?
In September, it was,
Mid-September?
yeah, let me look real quick. So it got as high as it was like 220.
Okay, so
And
okay.
so the highest it ever was, it got to about 300 vol.
But that was here. That was on the initial spike.
That was on that initial spike. But if you think about that spike, I mean, that's a spike essentially from what, 60 cents to $5
Yes.
or something. So that makes more sense. And then the second spike from 2 to 10 is less, right? Like from a percentage basis
Yes.
of how violent of a
much
move
less.
that was.
Okay.
So that's, yeah. So that initial spike was just, you probably had, if I was making markets in open, like my old job, and all of a sudden a stock I hadn't thought about in how many years had that been? I probably hadn't thought about this thing in, you know, a couple of years, and as it just drifted lower and it became essentially a penny stock, then all of a sudden I'm like, those first couple of days of that rip, I'm probably like, what the hell is going on? Right? Like, what just happened in this stock? And then all of a sudden I'm just like, well, I guess I got to get out of the way. You know, something's going crazy
Yes,
here.
I gotta get out of the way.
I got to
And
get out of the way. And you just basically raise volatility from 80 to 300 until you can figure out what's going on.
So,
right?
so what CC means by getting out of the way, that means he takes his loss and he moves on. But okay, I kind of moved this a little bit off here.
Yes.
So are we done with this? Are we done with this one?
Yeah. Yeah.
Okay.
Well, let's talk real quick, and this is just sort of general because we spoke about this last week. Go to that orange card real quick. I want to talk about, because we did this last week, and it's the first part of this card has already just happened, right? So we were talking about this when the VIX, you know, was sort of 15, and I think we had a little bit of volatility last week, and we maybe got a spike up to about 17 something, and that's what triggered this discussion. And this is basically, this is a good back of napkin rule of thumb if you're just kind of like trading the market. Maybe you don't even need to be trading options. This is more for like equity traders. So the first pullback from a low volatility environment, when the VIX is 14, 15, 16, something like that, it tends to get at least a temporary bounce somewhere on that first spike over 20 in the VIX, right? Which we hit yesterday. It went up to 21. So that's the first part of this card, is those tend to be the first bounce. And it's not a, this is all over with. It's more of like, oh my God, like we kind of lost our minds a little bit maybe over this story type of situation. So you tend to get that bounce. Obviously, we're beholden to the news flow on this one, I would say a little bit. We're beholden to, you know, the treasury yields, or, you know, like people are even talking about Japan yields again and stuff. So we're somewhat, as we always are, we're somewhat tied to like what caused this little pullback. So the thing to remember is, if this bounce does not hold, right, and it's kind of weak today, you know, it looks like it's trying to make a run into the close. We'll see how this plays out. If this does not hold, and yesterday's lows were
breached,
what? 69 or 67.90, 67.90, let's call it, in the cash. If those were to not hold, you would probably need a spike in the VIX. The VIX is what, 19 right now?
Mm-hmm.
You would probably need to see it in the upper 20s. And I know that's not very good, because that probably means a much deeper sell-off from here.
We got a question directly related to this, and I want to get that before I move on.
Let's hit it.
VIX has been over 100 since last week, and now at 111. If that is not down below 100 or over in the mid 90s, any warning sign there?
Wait, say that one again.
So VIX has been over 100 since last week.
I don't know what they mean by that.
The VVIX.
VVIX. Got you. Okay, let me look.
Okay. Yeah.
So the VIX of VIX, right? Okay. So that one is interesting because it's completely dependent on where you started from. So for now, I don't think that is, what was the end of the question? What were they looking for?
Is there a symbol for this that I can pull up or not?
There might be. It might be tough because it's not like a tradable asset, I don't think, unless
let me finish the question.
So what was the end of the question, Joel?
VVIX had been over 100 since last week. Now 111. If that's not down below 100 or even mid 90s, any warning sign there?
If you type, by the way, Joel, if you just type, I don't know what trading platform, but if you type it into like Google, you get it. So, okay. So this is dependent on where you started from. That's the way I would start it. So Joel, just to kind of do this like explain this as simply as possible. So this is sort of the volatility of the VIX, right? So when the VIX is 30 and it goes to 40 and then it goes to 25 and then it goes to 40, it is not affecting this as much as when it goes from 15 to 25 to 17 because the percentage moves. It's the, you know how they like on CNBC, they'll be like the VIX was up 20%. And then most people in sort of derivatives and all are like, that's kind of a silly way to think about that because it's like a percentage of a percentage. Like it's like derivatives all the way down. This is actually what that is. And so this is the type of thing that blows out those volatility ETFs. Yep. Is when you get a move from like 14 to 30, and then all of a sudden, like you've broken like VVIX and, like everything sort of associated with it. So I would say I wouldn't be concerned about it because what we just saw was a very low volatility environment coming out of the holidays. And now we're getting volatility. I would use the pure VIX as a little bit of a better signal as like when to buy and all. If you got moves in the VVIX and it maintained a really high level for a long time, that might be a sign that something's broken, but we're not there yet. So that would be a sign that like the sort of the derivatives market's under pressure, I would say. So, but going back
to I have to run solo here for 1 minute, okay?
Yeah. So I'll just talk to this real quick. So what I would be saying for the sort of the home viewer, we got the spike in the VIX to 21. If we hold short duration bounce, I wouldn't get too excited about it. You might want to, like, if you bought today or yesterday, you got your bounce up like 100 points or something like that, I wouldn't get that excited about it. I would kind of like take off some of that short duration bounce play, because if we then go back and test those levels from yesterday, I think we would probably need to see a VIX of at least 25, 26 to signal the next capitulation. On this card from last week, a like a VIX of 30, you're going to be right a lot of times buying the market on a VIX 30, because the rare cases where you get the VIX 50 and VIX 60, it tends to be some big like last year's tariff tantrum. I doubt we're going to have anything like that coming up. So anyway, these are sort of like, just know that like if we get a bounce and the VIX goes back to 17 and then we sell off again, the VIX hitting 20 again is no longer a buy signal. You need it to be higher. You need another separate capitulation that like flushes people out and then gets a panic buy on the bounce.
Okay. All right. BZ, let me go back here and see if that's good enough for BZ Tokyo. He said, thanks. Got it. Yep. Also, I found my my SIBO VIX. It's traded down $1.72 today at 1837. So is that the VIX that you like to follow?
Yes, exactly. And there's, I think it's the main thing. It's the one on TV, right? And I tend to, I tend to use, we talked a little bit about 0DTE trading last week and, what kind of like moving averages I use and all. I want to always consistently be using the one that everyone else is using, right?
Yep.
And I'm not trying to find, some people have their own things and their secrets, but it depends on, it kind of informs their own trading. But I like to see what everybody's watching. And when everybody's watching the VIX on CNBC on their TV and it's at 50, that's a really good sign to back up the truck and buy everything. Because that is the general public in a total panic.
Okay, so we do have some symbols coming in here.
Yeah.
So I'm going to go back to StreamYard, and I'm going to remove this. And let me go first. Let me go to the STN chat. Let me make sure I got my questions there. Okay, we got so the first question coming out of the STN chat is from Bill Big D. He's one of our favorites, and that's CRDO, Credo Technologies, and that thing has been taken out to the woodshed here. Talk about Bill's a pretty bullish trader here, so
Whew, look
I
at
can
this.
either bring up my chart or you can do your fancy options AI.
I've got it. Let's look on the options. Let's go to the options AI chart. So they don't report till the first week of March, it looks like. This is, I mean, that's a troubling chart if it doesn't hold right here, I would say. Let me just, I mean, yeah, like look at that 5-year chart. So you got this move, basically since the last tariff tantrum of, I mean, this thing was a $30 stock. It's up $100 since these lows of last April. So obviously it's well off the highs and all. So I assume this is a bullish question. This is probably the perfect thing to use options instead of the stock because you could define your risk. And so if you were going out beyond that next earnings, and let's just go out to, let's go March 20th. So this is the monthly expiration beyond when they report earnings. And I'm sure that earnings isn't confirmed yet. So what I would be looking at, just shopping around, having not looked at this, I would be first looking at like how expensive a call is. So the at the money one, it's not even at the money, it's a little out of the money. The 140 call costs $21, Joel. So you can see that on a chart. You would need a move back up above this just to break even on this call, right? So therefore, what I would immediately start to look at is what if that was a call spread? How much am I getting? So this is a 140, 175 call spread, which is nice because it picks up that little shoulder of, whatever this head and shoulders type thing could be. And that 140, 175 reduces the cost of that by $10 because you can sell the 175 call at 10 or around $10. So that reduces your cost now from 21 to 11, and your break even is now 151. And I'm sure it was just there this morning. So it was as high, it was already above your break even this morning, right? So that's the kind, I think it looks something like this. If you're like, oh, that's a little too pricey for, my tastes, you could do something slightly out of the money if you're, again, this captures earnings. But I think, this is the type of thing that you want to do a call spread in because options are really expensive. And, I think most people would be thrilled with a move back to 175. And you'd basically, you'd be risking 10 to make 25 in this case. And it was there. It was literally there this morning. You're above your break even. And it certainly was yesterday. So that's how I would be looking at this is I would first look at a call, too rich for my blood. What's a call spread look like? And then I play around with the strikes, see what my break even is, see what my risk reward is. Because I think, if you're bullish in this, 175 seems very realistic, especially with that volatility. It's nuts.
Okay. I want to make that they're saying you look a little bit frozen. I just want to make sure that everyone could still hear you.
How do I look now?
Let me go. This could be. Am I frozen too?
And is it just on STN or is it on YouTube?
I'm looking on YouTube.
Well, if you missed it, it was great content, right, Joel?
Yeah, it was. I wonder. I guess. Are we still live? STN room? Can you help me out here? I want to make sure we are still going live.
We didn't have a timer on it, did we?
Yep. Nope.
Okay.
We're still live. Okay.
Cool.
All right, no, you're back. I see you moving. Okay,
We'll
all
do it.
good
We'll
now.
do it live.
I know what it was.
What was it?
Um, my guy's tuning on my generator, and I told him when he runs the test to let me know if he's going to have to shut things down because I don't want to do it until 2:30. And he goes, "Well, I just got to testing now." So
Wait, you're not getting this storm that's about to hit?
nah, we're just getting
Uh,
peppered. 2
okay.
3, 2 3, 2
Okay.
3.
This storm, by the way, I mean, for next week and all, I mean, I don't know. Like, there's kind of an interesting like market variable coming up.
Yep. Let's
Is
do
like,
some more symbols and maybe we can
yeah.
talk for some trades about that. Let's go to a couple more here. I want to go to CoreWeave, CRWV.
Mm-hmm. All right. This is going to, I mean, all of these things are just awful from these IPO stocks from last year. So this thing's clearly attempting to bounce. It's, just to look at the earnings. So it's coming up February 9th, I have.
Yep.
The expected move is 17% for earnings, by the way. So of its prior earnings, this must have been the first one after it IPO'd, must have been, it barely moved. But then it moved, it was down 20% on earnings, and then it was down 16% on earnings. So yeah, this is an interesting one. It's gonna, the chances are it's gonna move. And if you were playing for a bounce in this is very similar to the open discussion we had earlier. You have to be more once you have a move back like this, you have to be much more realistic in your assumption of where a stock like this can go. And the options market is assisting you in being realistic. So for instance, as big as a move as 17% sounds like when we say it out loud, that is only really getting you up to about 105 in this stock. So you have
Overhead supply. I mean, it's one of the main tenets of pre-market prep. When a stock's making new all-time highs, who's selling, right? That's
yeah,
great. It's
totally.
perfect. Everything's it's nirvana. Okay, let's get a couple here coming out of the YouTube chat. RC420 is looking for some cheap weeklies and some low price stocks. So we
Ooh.
from our hot rod stocks that are getting killed, we can go a little bit. I mean, a little bit. He's talking about rig. I mean, rig to me, when I look at a $5 stock, you do a $5 stock. Is there any
What symbol?
options that you want to look at in a stock that low? Is it
What's the symbol?
RIG?
Oh, rig. Oh, I bought some of these last week. So and we joked about it. Brent and I joked about it. It was, yeah. Because it's kind of funny, like buying an option in a $4 stock, because a $4 stock's kind of an option in and of itself.
Yep.
But I can tell you which ones I bought. Hold on, let me look. I bought the. Let me just scroll. I bought the March 20th 4 calls.
Beautiful.
Yeah. And then what is that other one? Okay. So basically, let me just go to it and show it to you real quick.
Okay.
So the March, I don't know why I chose March or anything, but I figured I needed some time. I think this was being talked about a little bit in the STN room, maybe.
Right.
So the March this is now 4.5. Let me go down. So this was essentially, I saw this as a cheap stock replacement. I think I paid around what was my average price? Like 50 some cents, right? So this is how I would do a stock like this. Is the stock's so cheap, the options are cheap. Don't do like any kind of spread or anything. You want to buy this, be there for, in case you get a move, and then you can deal with like maybe selling a call into it or something like that. But for this, this was a 50-cent call that I bought, the 4 strike, and it's already above my break even. So it's essentially now I have a free look if this thing can go higher.
Okay. All right. And so now with, so if you're not in it, it's a big move today. I would maybe hope for a couple days, maybe a consolidation before. I mean, you're chasing it here. Probably things are it's up 33 cents. I guess from the high to the low, it's got a nice boost, but maybe looking for a few days of consolidation. Let's stay on the low price stock, Pfizer, 25.68. Moves around pretty good for for a weekly. I mean, what do they want for the 26s, right? I mean, I bet you
I
for
forget.
today's Wednesday,
Yeah.
I bet you they want at least 25 cents for the 26s.
So are we talking this like expiring in 2 days?
Yeah.
All right. So this is what do we got here? So good, too big of a chart. All right, so that's the 25.5. Let me go to the 26s. So they want 5 cents for those. Could that be right? Could that be
maybe.
right? Let me just go to the chain. So no, that's not right.
You're going to need an upgrade.
No,
you're going to need.
They are 4 cents at 6 cents. So you would
Mhm.
need, and something like this, like especially a boring stock like Pfizer, you look at that level, Joel, like this chart is a 3-month chart, and like the high in December was 26.40. The high this week is 25.90, basically. So it makes sense. I would not sell anything ever at 5 cents, but you would need more time. Let's just look next week, by the way. And when does Pfizer report?
Yeah.
They report February 3rd. Let's go out there. All right. This is the kind of thing where I used to hate making markets in options in stocks like this because you can never selling calls.
Never get enough premium.
You just don't get enough, right? Now, if you get lucky in something like this, you can make a lot of money. Like if a news story comes out but them crushing earnings, I mean, the biggest move I see over the last couple of years was 6% move, but most of these moves are like 1%, 2%, 3%. So you've got to be very realistic on this.
Yeah, he's looking. Yeah, I guess on big down days in RC 420. I mean, I talked about the institution stepping up at the $25 level, so he was picking them up cheap at 2 cents and just flipping them out.
What was the October news in that, real quick? Do you remember? It
Trump.
went from like 23 to 27. It must
Trump.
Okay. Yeah. All right. I figured that's what that looks like. And by the way, for all the taco trade talk to the downside, man, you'll see a lot of charts like this. Like, this is like Oracle in miniature, right? Where you get like some massive move, and then ultimately people are like, let's forget about that. I kind of feel like that credit card stuff going on right now is a version of that. Like that ain't happening.
Okay. Yeah. So let's go to one more to get back on the wild child side. And I want to make sure we're going to go to Bloom Energy.
Okay.
And I wanted to see there's
it's BLMV.
BE.
Oh, BE. Okay.
Yeah. Ideas on selling puts in general. Would like to own, but this run up is insane.
Okay. So we talked about this last week, and there was a question on selling SPX. I think it was SPX puts, short duration for the next week or something. And on the show, we said, do not do that. Vol's too low. And had you done that, you would have gotten burned the last couple of days. When I see a chart like this, I would offer the same advice is, if you were going to sort of sell puts on the way up, it's just that chart is just too much risk of this pulling back. So like, what could you sell? You'd be going down to like, if you sold a 125 put, you could get burned on this thing bad. It could go to 100, right? In no time, right? It was there in a couple of weeks ago. So I'd be very careful selling puts here. If you did want to sell downside, I would be using that to potentially buy upside. And when I see a chart like this, where I'm like, I've missed this move, we all have that feeling, right? And this thing could go higher. It could look like Sandisk's chart. The way I tend to trade something like that is I take little shots to the upside that I would be thrilled to be right. And I'm going to show you a version of it. So this is going out to February. And we're going to do just like kind of like a real, like this is like a 170, 175 call spread. Okay. And this is the type of thing where, and this isn't, I just literally pulled these strikes up because I was wanting to get it to a 1 to 4 risk reward. This is the way I would position in a stock like this, where I'm like, I wouldn't buy it with your money after a run like that, but I still kind of think this thing could keep squeezing higher. I'd be doing little option trades like this. In this case, this is buying the 170 call and selling the 175 call. If this thing squeezes through it, I make $4 on my $1 risk, right? If the stock goes lower, I'm like, thank God I only did $1 and I didn't buy the stock here or sell puts, right? So this is the way I would do it. And so to the put, like if you really want to sell puts and collect premium, I would be doing kind of the same thing on the downside, which is, I'd be risking maybe 350 to make 150 and hope I'm right. And then if I get burned on it, I'll be like, thank God I didn't sell like a cash secured naked put, because I'd own this thing for the next 10 years, trying to get my money back.
Okay. All right. Bill Big D says don't sell your puts on red days. So that's true. Okay. Well, we meant to go a half hour. We went 50 minutes here, but great content. As always, busy week here on the Stock Trader Network with CC. Thank you so much.
Yeah.
Excellent. Once again, is this did we get our third Friday out of the way? Did I already mess
that
this
was
up?
last week?
Okay.
By the way, a lot of the volatility this week can be directly attributed to the fact that last Friday was options expiration. So it just clears everything. The week to a week and a half coming out of an options expiration oftentimes is the most volatile uptick in volatility from a low vol standpoint. And that's because all of that options has cleared. When the VIX is 30, it's the opposite. If the VIX is 30 and the market's going crazy and everything expires on a big options expiration, the market tends to settle down after that because all of that short gamma is gone. So anyway, good rule of thumb to pay attention to those expirations.
Tim Quast from Market Structure Ed talks about the books getting cleaned out at the at the end of the month. So another great session, CC. Busy week here. I'll try and get it. I want to get in touch with you. If I don't do it by the end of this week, you're on the docket for next week. So folks, thank you in the YouTube chat. Thank you to our loyal STN crowd, and I'll be back again 3:30 with that closing print, folks. So everyone enjoy. Thank you, CC.
Thank you. See you all.